Part 3, the reinvestment rate risk. So here, the reinvestment rate risk concerns the fact that when the yield to maturity falls, the market interest rates decrease, any cash flow available for an investor have to be reinvested at a lower rate. When you reinvest at a lower rate, your future value will decrease, so your income will decrease too. Here, the first, in the second part of this chapter, we covered the impact of an increase in the market interest rates that will reduce the value of the bond. Only we will see another interest rate, which is the fact that when the reinvestment rate risk, your income, when the reinvestment rate decreases, your income will be reduced. To better understand this, let's see this example 19. Suppose you just won $1 million, you have $1 million, and you intend to invest the money and live off the interest. Here you have two alternatives. You have the choice between investing your money in a 10-year bond. You will buy today a bond with a maturity of 10 years, so you will receive the interests during 10 years, a constant interest, or you can invest your money in a series of 10 one-year bonds. So you buy a one-year bond today, you pay its price today. 1 year from now, you receive the coupon, the interest, plus the par value. Then you buy another one-year bond until the end of your term. Right. Both 10-year and one-year bonds currently yield 10%. It means that the interest, your return, if you invest on this bond, will be 10%. The question is, what is the impact of a decrease in the market interest rate to 3% instead of 10%? What is the impact of this decrease to 10% on your future revenues under each investment alternative? If you choose to buy a short-term bond, because according to what we saw in the part 2, the shorter the maturity of a bond, the lower will be the interest rate risk. So if we follow this logic, we choose a bond with a short maturity to reduce the impact of any variation of the market interest rates on the price of this bond. If we choose the one-year bond, after 1 year, we will receive the coupon, the interest. We invested $1 million. The coupon, the interest is 10%, because the market interest rate is 10%. So we will receive the coupon, 100,000, and $1 million, the par value. But when we decide to reinvest our money, reinvest the 1 million, for example, to live off the 100,000 and to reinvest the principal, the 1 million. 1 year from now, if the interest rates in the market fall to 3%, all the available bonds will pay 3% coupon. So you will find only bonds with 3% interest rates. So your annual income would be $30,000 instead of $100,000. So you note that the reinvestment rate is now 3% instead of 10%. So this short-term bond is very risky when we talk about the reinvestment rate risk. But if you choose the 10-year bond strategy, you bought the bond today and you lock your interest in 10%, at 10%. So you will receive each year, at the end of each year, the same amount, which is 10% of the par value, $100,000, regardless to the evolution of the interest rates in the market, because your coupon rate is 10%. So here, your revenues from this bond will be constant, and your revenues, if you choose the long-term bond, will be higher than the revenues when you choose a short-term bond, knowing that the interest rates will fall. So here, to sum up what we saw in this chapter, if we choose a short-term bond or a bond with a high coupon, the interest rate, the impact of the variation of the market interest rate on the price of the bond is low, because the sensitivity of a short-term bond or the sensitivity of a bond with a high coupon is low. When we talk about sensitivity, we are talking about the price, the impact on the price of the bond. But you notice, according to the previous example, that when you choose a short-term bond, the reinvestment rate risk is high, because you are not sure about what will be the coupon rate for new bonds that you'll buy one year from now. So you have a higher investment rate risk. Also, when you have a high coupon bond, the risk that the new bonds that you'll find 1 year from now, or in the future, the risk that their coupon will be lower is high. For long-term bonds, the interest rate risk is high, because the impact of any variation in the market interest rate will affect more the value of the bond. Also, when you have a low coupon bond, its sensitivity will be high, but the reinvestment rate risk is low. So the conclusion, nothing is riskless. Okay? So when you choose a short-term bond or a bond with a high coupon rate, you will face a higher investment rate risk and a low interest rate risk. When you when you invest your money in a long-term bond or a bond with a low coupon, the interest rate risk is high, but the reinvestment rate risk is low. And you have here a recapitulation of the difference between price risk, also called the interest rate risk, and the reinvestment rate risk. This is our chapter concerning the risk and the return of the bonds. So as you saw, we covered the different sources of return when you buy a bond. As we said, the return comes from the coupon that you receive, the reinvestment of this coupon, and the par value. And this return is affected by the evolution of the yield to maturity. This is why we analyze it in the part 2 and the part 3, the impact of the evolution of the market interest rate, the yield to maturity, on the risk of the bond, the price of the bond, and the your revenues if you decide to reinvest your money once you receive the coupon and the par. I hope it is clear. This is our chapter 6. Yes.